What do you make of the recent market move? We've come a long way, and the small cap index, where all the damage was done in the month of October and November, now seems to be flourishing.
Yeah, so I think what we have gone through is a slowdown caused by the absence of, or rather the reduction in government spending, and therefore corporate results were sort of weak. It was probably the worst downgrade cycle that we saw since the COVID period. Having said that, I think what has emerged subsequently is a very stock-specific market. So I think there are a lot of stuff that is really touching new highs. So IT, you can see across the board, the sector is witnessing new highs. Private banks, at least select private banks, are touching new highs. Digital commerce companies are doing well; they are all in new highs. So on and so forth. So it's become a very stock-specific market, whereas at the same time you're seeing retailing, correcting sharply, autos correcting sharply, oil and gas correcting sharply, etc., etc. So I think what was since March 23, for 6 quarters in a row, 18 months in a row, we saw a continuous upside. And that was broken in this quarter, the October to December quarter in which we are in. So I think that phase of across the board breadth of market going up, I think that has been broken. And I think we are now more into the sector specific stroke, stock specific rises and declines. That's the context that we are living in at this moment.
Give me an example that where do you see the transition happening? Where do you think that there is scope for underperformance in next 12 months? Where do you think there is scope for outperformance?
So I think more of the same. I think consumption has been fairly weak, and we are not seeing any triggers for that revival. Of course, there is some comfort that rural economy could kind of do well because of Kharif and potentially even a Rabi doing quite well. But consumption has really been absent, and I don't think there are any government initiatives also to kind of push that. Government is a lot more focused on the Capex side of the economy. So my sense is the underperformance in some of these names could kind of continue the consumptions to some extent, some of the automobiles, etc. And whereas what is exciting is the cap goods sectors, the digital commerce sectors, select private banks, IT. I think I'm very excited about IT as well. So on and so forth. I think more of the same is what you will see into the future as well. Having said that, I think there's an important event coming in January, which is the appointment of Trump. And I think that's a significant event which we must not underestimate, and what changes it brings to the table, particularly rise in the cost of capital. What implication it has for us is something that we need to watch out for. But I think from a bottom-up perspective, this is where we are seeing the favorable places to be and the sectors to avoid.
Morning. Just curious to understand your take on Trump 2.0 and what the implications are going to be for emerging markets such as India.
So quite a lot, right? I don't want to be going to the alarmist side of possibilities that a lot of people are kind of talking about, but just to make the case, see, my sense is that the Fed Reserve has already maxed out the money supply. In a normal economy, the fiscal deficit in the US is as high as it is, and it shouldn't be this high. This is a current account deficit country. So a lot of the macros are not really giving you any space. The fact is that from whatever I can understand, of course, interest rates are 10-year treasuries at 4.2, but even if the normal fiscal deficit manifests itself, people are expecting 10-year treasuries to go to 5. Now, if your risk-free rate is 5 and not higher, if not higher, then if you look at the mind of a FII, he's getting a risk-free at 5. He has to hedge the Indian currency. Let's say that costs 2.5%. So his benchmark is 7.5% minimum return. Now, let's say if he comes to an emerging market, he probably wants another 5 or 10% kind of a return for the risk that he's taking. Now, even if the market is expensive, then he or she is not likely to put incremental money. What that means is that the demand side for equities in India from the FIs could remain soft. You also should consider that US, with corporate tax cuts, with deregulation, which Trump is promising, etc., is going to be even more attractive. So the reason for them to come to India goes down for the next foreseeable future, which means that, like I said, the demand side for equities from FIs will remain subdued for quite some time to come. And as you can see in India, the supply side is very active, right? So LG is coming up in an IPO, Hyundai is coming up in an IPO, multinational wants to sell stock, private equity is selling stocks, Indian promoters want to sell stocks. So the supply side is quite active, whereas the demand side, at least from the FI, is not going to be as favorable. What that tells me is that the price earnings expansion is very unlikely as you move forward. So we are all betting on now how earnings trajectory will take place for equity returns as you move forward.
Yeah, the FIs might not find India interesting at this point of time or attractive on a relative basis, but the SIP flows have continued into the Indian markets, 25,000 yet again, and your own AUM has inflated to 10,000 crores, so congratulations for that. But what do you think of, where this money is likely to flow into? Because yesterday when we saw that data, there was a dip when it comes to the large cap category, and we have been seeing in the market of late, mid caps and small caps have again started to bounce back and outperform. Do you think next year there will be large caps that are likely to outperform, or do you think the mid caps still provide good comfort and the opportunity to have outsized returns?
See, we have been in a bull market, and the India story is really being played in the mid cap and small cap. Every new sector that you look at, defense, electronic manufacturing services, engineering services, power transmission equipment, etc. All of that really is in the mid cap and small cap space. And we are still in a bull market, right? And I don't think there are any macro changes that have taken place which are dramatic, which should cause any significant pause yet on the economy side. So my sense is that these stock-specific stuff will kind of continue to do well even as you move forward. There may be some temporary challenges, as I point out, thanks to the macroeconomic variables which may change. The rupee is already under pressure. We will not be able to reduce interest rates as quickly. Fiscal spending, there will be some challenges given the global pressures that we are having, etc., etc. But I think you need to extend your time horizon to gain meaningfully from the mid cap and small cap spaces. I think as you move forward, I'm a little apprehensive of what is to come starting January, and that's what you need to keep an eye on.
There are a lot of these new themes which are emerging up. One is quick commerce, second is clean and green, third is solar. What are the themes for 25?
So I think these are all the names that you mentioned, Nukunj, are all multi-year themes. So my sense is that these themes will continue into the future. So all of the stuff, see, the market is forward-looking, right? So what is doing well today? Let's say IT, right? So IT is also, if you see, a lot of the sell side is probably a little bearish on IT. It's probably only at the margin that people are changing some of their view. But, if Trump deregulates businesses, I understand that $4 trillion of M&A is going to play out, right? Which has been kind of subdued. That benefits banks enormously in America, apart from the tax cut that is going to come in. So banks may feel very energized and willing to spend on IT. So you can see that even companies themselves are not at this moment giving you extremely positive vibes on IT, but IT stocks are all at a new high. So it is suggesting of what is forward-looking, which is to come. And I think all the sectors that I mentioned, which are looking attractive, are all probably themes for 25 as well, which is capital goods, quick commerce, digital commerce, in fact, which is a much larger canvas. I would say private banks, IT, so on and so forth.
So where is IT headed, if I want to be specific here? Anisha and me were discussing in the morning that here's a sector which best will give you a 10% growth. And if I say 10%, I'm being charitable, right? P multiples are 20 times plus across the board, trailing, not forward, right?
Yeah.
Margins have peaked out. So why are these stocks coming back the way they are? I mean, is it just because of currency? Is it because markets are in defensive mode? Or is it because markets are running out of ideas?
So I think there's a bit of a macro play here as well. I heard you in the morning talk about how Bajaj Finance is trying to become a Fin AI company. And I was there in the meeting yesterday, and I think Sanjeev Bajaj was talking about they have 300 projects in AI. So AI clearly is going to, corporates are going to adopt AI, which means that they're going to spend on AI. For the moment, the projects are quite small, but I think that's also a area where IT companies are going to spend. Second, I pointed out the US macro. If it improves, then that's going to mean spending coming back. So the growth rates, which have been 3 or 6%, will probably become 8 or 10%. By the way, that's in dollar terms, right? Third, I think you mentioned that margins are peaked out. I would disagree with that, right? Because operating leverage, if the business size of the business grows, actually, a lot of companies are pointing out that our margins would expand, 200 basis points, 300 basis points. Plus, you must know that these are very high free cash flow businesses. So they pay dividends of probably 3% yield or 4% yield. So you can get 3 or 4% from the dividend. You can get maybe 10 or 15% on the earnings, probably if not more, and a little bit on the price earnings. That makes, if you accumulate that, you could make a 20-25% equity return. For the tailwinds that the IT sector has, my sense is this is a good equation to have.
All right, Rajesh, really appreciate your time. Thank you for joining us, and certainly hope to see much more of you going forward.
Thank you.
Metal stocks are looking okay. Select solar stocks are looking okay.
If you like this video, then like, share and subscribe to ET Now.